Markets don't crash because of headlines. They crash because liquidity disappears. Right now, across global markets, liquidity is quietly drying up, and that's why every rally feels weaker, every sell-off sharper, and every dip buy less reliable than before. The warning lights are flashing, even if most investors aren't watching. What liquidity really means? Liquidity isn't just about how much cash is in the system. It's about how easily that cash moves. When liquidity is strong, there's always a buyer on the other side. Stocks rise, credit spreads tighten, and volatility stays low. But when liquidity dries up, even good assets start falling because no one wants to catch the knife. Right now, the global financial system is facing a serious liquidity squeeze. The Federal Reserve, the European Central Bank, and the Bank of Canada are all still running quantitative tightening, QT, draining hundreds of billions of dollars from the system every month. That means fewer dollars available for lending, trading, or speculation. At the same time, U.S. Treasury issuance is exploding to fund massive deficits. That flood of new bonds is soaking up the remaining liquidity, leaving less for equities, real estate, or crypto. The same dollars that once chased stocks and AI names are now being pulled into safe government paper yielding over 5%. The cracks beneath the surface. This liquidity squeeze explains a lot of recent market behavior. 1. Stock rallies are stalling. Major indices are struggling to push higher despite strong earnings. Buyers are exhausted because money is getting scarcer. 2. Credit spreads are widening. Companies are paying more to borrow, and junk bond issuance has slowed sharply. 3. Emerging markets are suffering. As the dollar strengthens, capital is flowing out of developing economies, tightening global liquidity even further. 4. Crypto and speculative assets are falling. When liquidity is plentiful, risk assets boom. When it's scarce, they collapse first and fastest. This is what traders mean when they say, the tide is going out, liquidity is the tide. And when it retreats, we find out who's been swimming naked. The Federal Reserve's silent role, the Fed isn't just keeping rates high, it's actively draining reserves from the banking system. Bank deposits have fallen by nearly $1 trillion since 2022. The Treasury general account, money market funds, and reverse repo operations are all pulling cash out of circulation. In short, the oxygen of the market is thinning. That's why the same macro events, trade tensions, weak data, or corporate downgrades, suddenly cause outsized market reactions. With fewer buyers and smaller balance sheets, price swings become violent. Why this matters for investors: when liquidity dries up, valuations stop mattering. Fundamentals take a backseat to survival. Even high-quality companies see their stocks punished as funds rush to raise cash. The danger is that this process can snowball. Falling prices trigger margin calls, which force more selling, which drains even more liquidity. It's a chain reaction, the same dynamic that turned small sell-offs into full-blown crises in 2008 and 2020. Can it be fixed? For liquidity to return, central banks would need to pause QT or cut rates, but inflation remains sticky, tying their hands. Governments could slow bond issuance, but fiscal deficits are rising, not shrinking. That means the squeeze is likely to persist for months, if not longer. Markets can survive many things: inflation, war, politics, but not a liquidity drought. Liquidity is the bloodstream of finance, and right now the patient is showing signs of shock. Final thoughts: liquidity doesn't disappear overnight. It fades slowly, quietly, until one day it's gone, and that's when the real panic begins. If you found this breakdown useful, hit like, subscribe to Financial Vlog, and turn on notifications for no-fluff market insights that cut through the noise. Because when liquidity vanishes, those who understand it don't panic, they prepare.